Hello everyone, welcome into Above My Pay Grade. My name is Eric. Your retirement account is in trouble if you have a state pension specifically, but even if you're a federal employee, I want you to give you some food for thought. Now, there's two types of retirement plans. You have defined benefit versus defined contribution. Most state pensions are defined contribution, meaning if you contribute money into the plan, then you get your contribution, or your payout rather, in retirement is based off the contribution you put in. Now, the problem with these state pension plans, they have to get a return. And in the form of CalPERS, so CalPERS is the biggest pension fund, I think in the United States, maybe the world, state pension fund. They have to get 7% rate of return on the money that people put in order to pay out their beneficiaries. And so if that, let's say they get a negative 15% one year, that's just eating into their treasury that they're trying to get a return on. So that can't last, right? So usually pension funds, I did a video about this a while back, pension funds invest in bonds and equities or stocks, and that's how they get their 7% return. They have a certain amount of safety, and then they have a certain amount of risk in equities. Now, bonds are returning in negative yield, negative real yield when it comes to inflation. So not only are their bond portfolio in their pension yielding negatively, that means their equities have to yield that much more in order for them to make 7%. And in a market like today, like the first half of 2022, your equities are negative too. So they're in trouble. They're getting to be insolvent. So federal employees have a defined benefit plan. If they're in, let's say, the military and they serve 20 years, then they get a certain amount of money for the rest of their life. The military is slightly different than other federal jobs because part of that is a retainer to get you back into the service if needed. But suffice it to say, federal employees get a defined benefit plan based off of the time they have vested in. And the federal government, much different than states. Why? Because they can print money. So if they need to pay their employees, they don't have to get a rate of return in the market. They can just print it. Obviously, that's inflationary, but they can just do that. States cannot. So what happens to your retirement if they can't pay you out? I mean, you think about it. You don't get the benefit you were promised. And if people keep insisting that they get the benefit that was promised, and a good example of this is Social Security, if people keep insisting they get the benefit that they were promised, eventually that runs out of money sooner rather than later. So either everyone takes a haircut or people in the back of the line get zero. That's what happens. So what I recommend doing, and some food for thought, I've been in the military for 15 years, and I plan on doing 20. And the federal government has promised me for the rest of my life to pay me, if I retire, pay me a certain amount of money in dollars. Okay? Like I said, they'll print it in order to make me whole. That doesn't mean they promise to pay me a certain amount of purchasing power. They just promise to pay me a certain amount of dollars. And supposedly it's inflation fighting, meaning you have a cost of living adjustment based off of what? The CPI. The CPI drastically underestimates inflation. Just take a look. They said 9.1% recently. And I mean, are you experiencing 9.1% in your daily life? No. Goods and services are up 20, gas is up 100, blah, 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 blah. So it drastically underestimates. And if you compound that year over year, your purchasing power dwindles, right? Because the CPI is for a good reason, for the government's sake, underestimating inflation. So what do I recommend doing? You, in a way, are investing in dollars when you work for the federal government or state. You are investing in dollars and you are saying, I believe in the system, because the system's going to pay you out those little greenbacks, those notes, right? Or whatever currency the government comes up with. But they promise to pay you not in gold, not in anything else, but in the currency. So a lot of people don't have this luxury, and most companies can't pay out pensions for a reason, because they became insolvent, the car companies, etc. And only the state and federal still get pensions. But if you're in that bucket of people who get this pension, why don't you put the money, the extra money that you get every month, into something other than dollar assets? I mean gold, silver, real estate, and Bitcoin. Because that is a hedge against the dollar superinflating. And then if you think about your pension fund, right, it's invested in the market. If you have a 401k as well, your pension fund's invested in the market, your 401k is invested in the market, both go down, you have some issues, right? And that's why I think it's important to hedge in hard assets, things that the government can't print more of. That includes stocks to some degree, because stocks, when government prints money, stocks, the price to earnings ratio, meaning the value of the company, goes through the roof. It's illogical. If you look at the PE ratio of stocks, I'm not saying stocks are a bad investment, but right now, if you look at 2020 and 2021, how overvalued stocks were, you're like, wow, I mean, it's bound for a correction. It's completely illogical. But when you buy hard assets, it's a slight hedge against government printing, especially if that government printing is your retirement. When your retirement is vested in a return in the market or government printing, like a federal employee, why wouldn't you want to hedge and buy things that the government can't print more of? Now, in my opinion, you have the best of both worlds. Because if gold doesn't really go up in value, that means something else for the dollar, right? That means the dollar's going up in value and people are wanting to hold dollars, which is good for you if you're a government employee because you're getting paid out in dollars. So you have both areas covered, in my humble opinion. I think it's only a matter of time. And if you look at what Biden did with government pensions, I did a video on this the other day. He has said that the federal government is going to be a stopgap for these pensions that can't pay out their beneficiaries. So that just means more government printing. And again, they'll pay you back in dollars, but they won't pay you back in purchasing power. So most people's understanding of their payment and what they're getting out in retirement is they're thinking about it in purchasing power terms. The government's thinking about it in dollar terms. So if you lose a quarter of your purchasing power but get the same amount of dollars, that's good for the government, not good for you. So I would put your money that you save somewhere other than government or let's say government-backed fiat and fiat investments. I would put in things the government can't print more of. Let me know what you think in the comments below. That's what I'm doing. And I'll see you guys in the next one. Peace.